Greetings, and welcome back to the Rose Bros podcast. This episode, we are joined by Bryden Teich, partner and portfolio manager at Avenue Investment Management, an independent private wealth management firm with approximately $400 million under management. Bryden joined Avenue in 2013 and earned his CFA designation in 2015. Prior to joining Avenue, Bryden spent time working in the debt capital markets at TD Securities. He also graduated from the University of Toronto in 2012 with an honors degree in economics. We sat down for a smooth cup of Rose Bros coffee and discussed investing your own money alongside clients, avoiding zero, taming volatility, why markets are not efficient, the value in recognizing patterns, avoiding fragile assumptions, thinking independently, admitting when you're wrong, what makes a good investment, and generating creative investment ideas. Enjoy. Also, apologies in advance for the scratchy audio. We had some difficulties while recording, but you should be able to hear most of the conversation. This podcast is sponsored by headracingcanada.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny Osborne-Parody, headracingcanada.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info and get your high-performance ski gear for the upcoming season. All right. For the listener, you are the partner and portfolio manager at Avenue Management. How'd you get into investing?
Good question. So like most people, in the last couple of years of university, I think you end up sharpening your focus on, what you are interested in doing or what you want to do, post-graduation. And so born in Toronto and went to U of T and was there actually on a athletic scholarship. So I was there playing hockey at the University of Toronto. And halfway through, I'd say, my university playing career, I recognized, the bright lights of the NHL, were not going to be calling my name. And so, at that point, I started trying to figure out what else I would, be interested in and what I wanted to do. And investing was something that was always, I thought very interesting, and it kind of piqued my curiosity. And, definitely from my last couple of years of school on, I really started devouring as much information and books as I could on investing. And then from there, kind of, really started to solidify it as, the career path that I wanted to take after school. And so from there, worked at one of the big six banks for about a year, TD Securities was the department I was in. And then from there, was able to get the job at Avenue now about 10 years ago.
And like Ryan Bushell, the previous guest on the podcast, you are relatively young to be in a good position like this. So it's meant to be a compliment. Congrats.
Yeah, no, thanks. I definitely, the trick I had, and now even doing it, 10 years, I definitely still feel young, but my first year of working, I definitely have a clean shaven baby face. So, I very quickly realized the only, advantage I could have being a younger person is I had to grow a beard. So that's my desire to try to age myself. But I think even with the beard, I think it, sometimes my age shows.
Well, it's awesome. It's good to see. As a partner at Avenue Management, you are an entrepreneur. You own part of the business. To be a successful entrepreneur and to run a good business, you need skin in the game. Do you invest your money alongside your clients? And have you had to put money into the business?
Yeah, that's a great question. And I think, it definitely touches on, I think, one of the things that is generally lacking in the investment industry, and that's skin in the game or alignment. And that's actually really one of the core principles of why and how Avenue was founded. And it was on the idea of wanting to be invested alongside of our clients and owning the same investments as our clients. And so all of the partners have their investment accounts invested in our portfolio that we manage for clients. And so we're all, invested alongside clients. And I think that's critically important. Like you said, having skin in the game, and then also having a focus on, your own investments and your clients' investments. And, many of us do have family members that are invested as clients alongside of us. So it's something that, we treat like it's our own, and it's because it is. But I think that alignment is really important to have in an investment manager. I think it's something that the investment industry as a whole, I think, doesn't do that well. But it's definitely a core focus for us at Avenue.
Do you eat your own cooking?
Exactly right. And I'm not a good cook, but other than that, investing, cooking, I'm happy to eat all day.
In terms of running the Business Avenue Investment Management, did you have to put money into the company, or how did that structure work?
Yeah, so myself and another partner, have basically had to buy into the business essentially, and we've been in the process of doing that for the last few years, and we've just in the last year we were able to, or we finalized our payments on that. But I think that's an important thing too. I think it's, being a business owner, having your own savings and capital at work in the business, I think is important. And I think being, like a small business or medium-sized business, I think, having skin in the game and having ownership is also really important, in that it gives you not just a say of, the direction of the business and sort of the day-to-day, but it makes you really focus on what's important. And once again, it goes back to saying, having skin in the game, whether it's in a portfolio strategy or in a business, I think is critically important. And that itself is the best way to have alignment with yourself and your partners and then your clients as well.
Like I talked about with Ryan Bushell, one thing that's been on my mind lately is detecting skin in the game. A lot of management teams say they have investment in the company, but you never really know if the shares have just been given to them or where they actually had to take a second mortgage or actually put their own money in. How do you detect that? How do you look for that in management teams? Yeah,
that's a great question. What's interesting too is that this is something we focus on. I kind of just focused on this the last couple of months, just trying to evaluate a few businesses. But you often find, obviously, management teams are often, receive shares or receive options every year in the business, which is okay. That's kind of normal practice. And I think, but at the same time, if you're not buying shares in the company, I think there's not the same value put on your ownership. And I think what happens too, the one thing we've tried to really narrow in on and focus on is that from a corporate governance perspective, like there's companies who are very clearly incentivized to grow, or their actual cash compensation is very focused on like year-over-year growth. And if they're having to take on debt to acquire new businesses that they're growing, the CEO is getting paid more. And from our perspective, that actually is not really a great alignment with long-term shareholders, because you're obviously very focused on your year-to-year pay as a CEO. And so, companies that we like and, I think would rank the highest in that kind of alignment would be, companies, and there's a few of them where the CEO or the chairman of the board gets $1 salary a year and has all of their savings in stock of the company. And they're either the entrepreneur that grew the company or, have the majority of their net worth tied up in it. And when you can find those companies where someone has put their life's work into a business, and as a public investor to be able to participate in that, is really, really great. But I think that alignment, definitely has an impact whether you had to buy into a business or whether you were granted shares in the business. And it definitely impacts your perceived value of your investment, I think.
On the other hand, sometimes the business is just so good that it doesn't matter. I think that Warren Buffett's comment is that if you need a business so good that even if an idiot runs it, it doesn't matter eventually.
Yeah, it's a great point, but at the same time, I think those businesses are really rare. But then if you have those kind of businesses and you also have good management, it's where the stars align like that. It's amazing. And even I think the Buffett comment that's also like I find interesting with that is like you could find the most amazing CEO or leadership manager, in the economy. And if they're in a bad business or in a bad sector of the economy, it doesn't matter what they're going to do. And it's just that business. And, the example he gives was with Berkshire Textiles, just saying no matter what they did and how much capital they put into the business, there was going to be no return on that capital. And you could have the best CEO, but if you're in a bad industry or bad business, it actually doesn't matter. But to your point, if you can get, good business with great management, it's a dream in terms of investment.
You got to get in the right boat.
Yeah. And you have to make sure that everyone's rowing in the same direction as well.
The point of investing money is to make money. The rate of return is basically the scorecard at the end of the year. Is there a number that you look towards when you're presenting to clients or for yourself? How do you compare yourself? Is it the S&P 500? Is it a blended index? What number do you kind of base your business around, and how did you come to that number?
Yeah, that's a good question. So the one, like part of the language that we had originally used at Avenue, we've kind of shied away from this just because most of our clients are in equities, but a lot are in bonds too. And so to kind of separate what our expectations are for both stocks and bonds, we try to get away from this. But essentially, easy math is that $1 doubles in 10 years at a rate of about 7.2% a year. So to double your money, over that time horizon, that's the return that you'd have to achieve. And then obviously to get, to double it again, you need to get that rate of return, in the following 10 years to turn that $1 to 4. And so for Avenue in 20 years, we've been able to do that now twice from our original strategy going back to 2003. And so that's kind of a rough guideline, like for what we try to achieve. And obviously, over the shorter term, there's obviously a lot of noise about the index and is Canada doing better? Is the S&P doing better? Obviously the theme in the last 5 years has been, the NASDAQ had done really well. This year has been a terrible year for the NASDAQ. This year Canada is doing really well relative to lots of the other markets in the world. And so we try to not think about the year to year or even a shorter time horizon, what different indices are doing. And we try to focus on sort of that long-term compounding and really thinking of it as a sort of absolute return strategy rather than relative and certainly over a shorter time horizon. We're not interested in that. So we're trying to say, can we achieve a really good, reasonable rate of return over like multi-decade at our expectation? That's how we think about what our objective is, but we're really focused on the long term, which then, we can maybe pivot throughout the conversation. But the challenge for investors is, obviously the mindset, for clients and both for non-clients is everyone's always so focused on the short term. So how do you kind of think about the long term, balancing it about short-term expectations and trying to manage that difference? And I think that for investment managers, that's almost one of the most important things to do, and to be able to articulate to people what you're trying to achieve. You're trying to make money. You're trying to grow your savings. The whole principle of investing is you could consume your money and savings today, or you can say, I'm not going to consume today, and I want to consume this in the future, and I want to be able to consume more in the future by growing my purchasing power. That's essentially what investing is and what it's supposed to be. And I think it's almost like a first principles objective is always really important to kind of explain what you're trying to do. And it's, we're not trying to beat the S&P in 1 year. We're not trying to beat the TSX in 1 year. We're not trying to, do any of these shorter term things. We're trying to take your savings from today to years in the future. And in that process, grow your purchasing power so that in the future you can consume more and keep up with inflation. That's essentially what we're trying to do. But I feel like, once again, the whole investment management industry doesn't really articulate that and doesn't explain it. And it's all about products and themes and like trying to really focus on short-term things. And this goes back to, being a smaller firm, being independent. We can luckily cut out a lot of the noise and just focus on what we're trying to do. And that's really what we try to do with that one.
One of the main things in investing is also not to lose money. If you can avoid zero, it's one of the essential things that you need to do.
I think it's what's Warren Buffett's rule number one is don't lose money.
Yeah.
And rule number two is don't forget rule number one. I think something like that. So I think that it's critical. It's just like, anything compounding times zero is zero. And so I think avoiding really large drawdowns is the most important thing for investing. And I think what's interesting this year is, there's been, all kinds of things all over the place that have had these really big dramatic declines. Well, at the same time, the index levels, have held up relatively well, compared to a lot of the sort of decimation out there. But I think exactly your point, like, any number compounding times zero is zero. And so you have to avoid big drawdowns. If you can do that and you can be reasonably successful in stronger years, that's the best way to achieve sort of a compound rate that you're happy with. And that's ultimately the compounding rate, the geometric return is what matters. And each period in that series matters. And trying to avoid large declines is critically important.
In terms of earning a rate of return, inflation's been high lately, 6, 7, 8, 9, 10%, and according to who you talk to. How do you think about inflation with your investments? And if you're earning 7 or 8% a year and inflation is 7 or 8% a year, does that concern you, or how do you approach that?
Yeah, it's a good question. It's definitely been something that clients have been asking about a lot this year. And obviously everyone is feeling the impact from rising prices. And I think the challenge for inflation right now is it's definitely hitting, I would say the most vulnerable parts of society. So, definitely lower income folk, definitely retirees, anyone on fixed incomes or, pensions that aren't indexed to inflation. It definitely, hits a lot. And from an investment perspective, I think, we think of this going back to, a longer cycle. What is, the rate of inflation is somewhere between in a normal state, let's say 3% over a rolling many year period. And I think the question for right now is we've had the surge in inflation and it seems to have peaked and is in some process of rolling over. And I think the question for next year is just going to be how fast does inflation come down, and then at what level does it settle at? And I think those things are certainly uncertain right now. I would be more in the camp that I think that the timing of is, and I don't want to try to be too precise on it, but I would say that over the next year to let's say 18 months, I think that the inflation is going to be back well below expectations. And I think even there's a chance that we have a period of like negative year-over-year prices. On a 3-year basis, and that if you stretch it out, that maybe brings your inflation back to, a few percent a year over, let's say, a 5-year period. So you're in this aberration where inflation is high right now. In 2023 and 2024, I think inflation will be much lower. The path at which it gets there, I don't know the exact timing on. But I think the bigger question then is that on the other side of that, do we enter a recession which gets met by more stimulus, and then do we have inflation kind of resurge from there? And that's kind of sort of the path of inflation is what we're thinking about, and sort of how we're trying to think about our positioning. Because if we go from high inflation to low inflation, if not disinflation, back to high inflation, several years out, that's a really challenging investment landscape because certain assets will do well in inflation, other things do well not in inflation, and then you have to go kind of back and forth. And I think that's the challenge, over the next couple of years is like, where does inflation settle and what path does it take from here? And I think with how much central banks have raised interest rates and how much debt there is in the economy, our view at Avenue is that, the economy is likely to stall pretty significantly next year. I would say I'm definitely surprised and was wrong this year with having expected the economy to slow even faster. Mm-hmm. So there's definitely a resiliency to the economy this year that I think I definitely didn't appreciate. But that doesn't change where we are right now. It doesn't change how tight policy is. And it doesn't change the fact that that's just likely coming next year. And so that's the question is really, what does next year look like and how fast does inflation come down? And, we're trying to be as flexible in our thinking as possible because, for example, 2 years ago, we had seen an increase in the money supply that nobody in 100 years had seen. And so nobody knew what was going to happen. We could have a view, but no one had ever lived through that before. Today, we've got the money supply contracting at the fastest rate in 80 years. So it's in the U.S. So year over year, M2 is now negative. It's never happened before. So to try to have a strong forecast of what's going to happen in like 2 or 3 years, it's actually not even worth trying to do that as an investor, I think, because the uncertainty is so high. But you have to kind of have a view. You have to manage your expectations and look to confirm or ask yourself whenever you're wrong, are you wrong? And what are you missing? But I think we're, that sort of boom bust setup is kind of we're right in the period right before the bust should start. And the question is just going to be how severe is it? When does it come? And then, what is the policy response into that? But it's definitely going to make for a very interesting investment landscape over the next several years.
Part of your job is to manage capital for your clients, and sometimes they need to take money out. To Warren Buffett and Charlie Munger, volatility is your friend. It goes up and down, but in the long term, it smooths itself out into a good investment return. On the other hand, Nassim Taleb would say, never cross a river that is on average 4 feet deep. So if you take your money out tomorrow and you're down on a down year, although the average might be good, it's not good for your clients. How do you structure your portfolios for the clients so that on a down year when they need to take money out, they're not getting burned by a negative return?
Yeah, that's a great question. And those are two quotes on, other side of the aisle. And I think, so specifically the way we do this with individual clients, part of our financial planning that we do with everyone, essentially if you need money out of the market or if you need money out of your portfolio over the next couple of years, like we force people to have some money invested in bonds at all times. Especially if you're retired and drawing money out, you need to have at least several years of money in cash or bonds. For some clients, for example, we manage all of their equity strategy, but they might have a separate cash account or bond investment somewhere else, or vice versa. So we think of it not just about what we're doing, but what does the client have in their whole picture, and then making sure that whatever we're doing is appropriate from an overall allocation perspective. Like that's critically important, especially for people, once they stop working and are retired. That's something that's very important. And then as it relates to our investment strategy, one of the things that we do that's, I think, really unique in the Canadian investment landscape is we manage our equity portfolio in a, let's say, quality style, if that's going to be a thing. Mm-hmm. Then within our portfolio, we actually we have hedges against the market to aid in a catastrophic decline scenario. And so we use a small part of our portfolio every year to hedge against an outright sudden market crash. So, and that speaks to, the Nassim Taleb, don't cross a river if it's on average 4 feet deep. And that's just simple because 4 feet average, at some points it might be 12 feet deep. At some points it might be 2 feet deep. So to say your average anything is something, it's goes back to the geometric return matters. And so in that kind of scenario, the most damaging thing to any client or any investment portfolio is a catastrophic decline that doesn't give you the ability to recoup that because your timeline or your horizon for investing is too short. So someone who's in their 70s or 80s is not able to tolerate a decline of 30, 40, 50% if the market's going to stay there. And so we have part of our portfolio is a very small sliver that we use to try to hedge against that. And so we think about that question in two ways. It's what's best for the individual client based on their withdrawal requirements, but then our equity strategy itself has its own sort of component to it where we try to protect against that as well.
The average is great and all. It's a good marketing tactic, and it is true over the long term. But the problem, like you said, is when the client needs the money tomorrow. And if the market is down and your average on paper looks good, that doesn't really matter if you need the money and you're retiring now.
Yeah, totally. I think it's critically important too, because this is the challenge. It's actually better right now for people in fixed income and bond because we now have I would say back to a normal interest rate of 3.5%, 4%. Provincial bonds or corporate bonds that are giving you 4, 5, 6, 7%, even a short-term bond. So you can actually get a return from bonds. But the last number of years, you had the equity market doing really well, and interest rates were low, and bonds were really doing nothing. So it was definitely a fear of missing out by being in bonds the last couple of years. But it's critical from a capital preservation perspective, and having money in short-term bonds or cash is really important. And if anyone needs money from their portfolio tomorrow or in the next year or 2 or 3, you have to have some money out of the market to avoid exactly the scenario we're talking about.
As the job of an investment manager, your, goal is to earn a above average rate of return for your clients. That's the purpose. That's why they trust you. Also, not to lose money. That's another big part of it. But one of the main theories taught in the CFA program or an MBA program is the efficient market theory, where it's impossible to earn returns from the market because it's efficient. There's no room for pricing inefficiencies, and there's no point. But in a case like yourself, you would argue the opposite, and you've proven that there is opportunity for doing that. Have you found it difficult to go against the common narrative that the markets are efficient and everything you learn in school might be wrong? Or how do you think of it that way?
Yeah, no, it's such a great question, and you framed it so well too, because it's exactly that, where academically and theoretically, all of investing is taught one way, and it's very much, efficient market hypothesis, dividend discount model, do your, discount your cash flow back to present value, calculate that rate of return, that's your expected value. All of these things they fit very neatly into a academic curriculum, and the math is clear and understandable, but in practice, it almost completely doesn't work at all and is not relevant at all. That's what I would say. I would say that to myself, who graduated, a few months after graduation, like, do your best to try to unlearn everything that you just learned in university about investing, because in the real world, in the markets don't operate like that at all. And I think a couple of good things that I found very helpful in understanding this is definitely a lot of Nassim Taleb's writing, Fooled by Randomness, Black Swan, Anti-Fragile, Skin in the Game. Yeah. All of those books, like, they teach you one component about how the market is not efficient at all. The market's actually very fragile. The market is prone to boom bust cycles. And the other book that kind of, for me, and I actually just read it at the beginning of this year, but it completely smashed this idea into oblivion. It was reading The Alchemy of Finance by Soros. And so when he talks about reflexivity and his sort of boom bust model of, like, the markets can be in a near equilibrium state, or they can be in a far from equilibrium state. And to me, that is exactly, like, far from equilibrium state is no different than Nassim Taleb's, like, fat tail scenario. Like, that is essentially the same thing. And there's a symmetry in what they're arguing, but essentially it's just saying that the markets aren't efficient. The markets are heavily biased by investor psychology. The markets are heavily conditioned for, like, boom bust cycles, and they happen, over and over again in a very consistent way through history. And so, like, one thing I would say I would agree with is that, like, the market is very efficient at finding a price for a stock at any minute of the day. It's not arguing that the price isn't what the price is.
Mostly efficient.
Price, right? Yeah, the price is essentially, for any stock or asset, it's the supply and demand of price, which is, like, there's no denying that. It's not to say that, that price isn't efficient at every minute, because it's the price. Mm-hmm. But it's just saying that markets in general are very prone to boom bust, and they're not efficient over time. And I think, it's important to kind of understand the theoretical underpinnings of investing, and then you almost want to, like, go through and disprove these things too. One of the philosophers that Nassim Taleb talks about a lot in some of their books is Karl Popper. Mm-hmm. And so he was, like, a scientific philosopher, and he had this theory about essentially, like, falsification in science. So saying you can't ever prove something, but you can just work to try to disprove it. And as soon as you've disproved it, it doesn't really hold in a valid way. And this is kind of essentially the crux of, like, Nassim Taleb's, you can't say there's no black swans just because you haven't seen a black swan. But as soon as you see a black swan, then there's obviously a black swan, right? So this idea of, if you can disprove that the market's efficient and, equilibrium moment at all times, you can disprove that even a little bit, then the whole principle doesn't hold. And then there has to be more that explains it. Mm-hmm. So it's not to say that cash flow doesn't matter and understanding profitability doesn't matter. I think those are critical, but there are more things at play in the market. And so to just think about that segment or that understanding, I think, is very limiting.
It's a lot easier to figure out what's wrong than it is to know it's right precisely.
Exactly right.
And in the case of many investors, they have beaten the market consistently over the years, which would poke a hole in the whole EMT theory right there.
Yeah. If something can be proven wrong, then there's something else at play. Like, there are other things that are possible that I can understand too why academically it became a convenient way to teach theory. I think it's important for anyone coming up, educate themselves or going through school. You have to learn that stuff, but then you have to have a critical enough mind to try to, like, disprove that or add to it complementary. And I think there's Seth Klarman has a great segment of his book, Margin of Safety, and it's essentially saying, I'm going to try to paraphrase it, but it's essentially talking about the person at a farm standing on the sidelines, like watching you or watching how the horse rides and trying to explain, how the horse rides or how you should ride a horse, versus the person that's on the horse riding the horse telling you how to ride the horse. So something like that. And it's no different than investing, right? It's like there's these great investors who have been able to consistently have great results. That's who you should try to learn from, whether you listen to their conversations or read their books or study what they say, rather than, and not to be critical, but like the nice professor in the school that's never actually managed money. There's a difference, right? You're in the arena or you're not. And for me, after leaving school, like I'm definitely someone who values kind of the idea of lifelong learning and lifelong education. And for me, in its most simple way, I say, okay, I want to be as good of an investor as I can possibly be. So I'm going to go and try to find who I think the best people are and just study them and learn what they have to say, and then figure out what works and what doesn't work, and then apply that to what I think I already know. And that for me has been the best way to try to learn, is just, find and seek out the best people and their books and conversations or podcasts they're on, and then apply those skills. And for me, that's been the best way to kind of learn and adapt from a post-school kind of mentality about my education.
Lecturing birds on how to fly versus the actual practitioner.
Yeah, that's a faster way to say it. Yeah, it's exactly the same principle.
The CFA program, MBA programs, Bachelor of Commerce, whatever you want to call it, is probably good for a base knowledge. You put a lot of time into those kind of programs and a lot of stress and effort. How do you think about investing now? And how do you separate yourself from the curriculum and all the rest of the people that have taken those programs and learned the same thing? How do you generate creative ideas that do generate alpha nowadays and separate yourself from the herd in that sense? How do you think of it that way?
Yeah, I think the one thing I would say is that, and this kind of going back to originally, how we started it, was just saying how I got into the industry and how I end up kind of in my role right now. And I would say, if I were to take a step back and kind of reflect on it, what's interesting is that I have, I guess, a few certain personality characteristics or traits that I think particularly lend myself well to investment management. And I think that, for one of them, certainly, being an independent thinker, being a critical thinker, being curious, not being afraid to kind of be different or stand out in my thoughts, look where I'm wrong and try to figure out where I'm wrong first. Like all of those things, like having the humility about learning. But I think going back to education and then trying to pivot from that is that you often have to try to unlearn things and be really open-minded to different ways of teaching and different ways of learning. And it comes back to essentially trying to find the best opportunities for yourself. I would say our stocks and investments that have done the best have all been things that nobody showed to us, like nobody took us and showed us the idea. That's kind of one. It's a lot of the investment industry. You've got the banks and sort of research arm of the banks sending people on my side ideas and flow of like, hey, look at this, or it's a great thing you should look at. And I kind of do my best to try to reject as much of that as possible, because I find that finding our own ideas that no one has told us about have been our best investments by far. And we have different ways of trying to filter our sort of investment universe and knowing what criteria we're looking for, and then kind of being on the hunt for them. And we've kind of built our own little sort of list and database of companies that we think are really high quality throughout North America. And to be honest, like before even kind of going through that filtering process, a lot of them were companies that I'd never heard of. Like, working in the investment industry for a decade, and there's lots of companies that, we own now today that 3 years ago I never had even heard of them. Because no one's showing you these ideas. A lot of the companies that we own, they actually don't need financing. So you don't have a bank trying to push stock or debt to this company, because the company actually doesn't need any capital and they're doing fine just completely on their own. So that's definitely, a characteristic that I found. But really, the focus on independent research and trying to find our own ideas has been the most fruitful path for us. But it takes a lot of work, and you really have to love trying to find the diamonds in the rough. Like, you have to enjoy the process of that, where if someone just gives you a list of stocks that someone else curated for you, it's then prone to that person's bias or that person's view of the market. And I think you have to be independent enough and do the work to try to find your own stuff. And that's been our most successful path for finding investments.
One of the common themes I've noticed among successful investors, Warren Buffett or Naval Ravikant in tech, is the common is that you just read a lot, read all day long, sift through things, and maybe, like you said, finding diamonds in the rough.
Yeah, I if I could just sit at my desk and read all day, I would. It's like almost a perfect day for me.
Yeah.
And unfortunately, like my days don't consist of. I would say the one thing right now, and my wife and I now have a 2-year-old and a 1-year-old basically. So like that, my additional marginal reading time has been taken up. So I try to consume stuff when I'm in the car or audiobooks, and I have my kind of my library of books that I go through kind of regularly. And I would say my partners and colleagues would joke about the amount of books that are on my desk or on the floor beside my desk. And they say, well, he buys all these books, he probably doesn't even read half of them. And I definitely feel guilt for not reading enough, but I think it's a great way to consume information. And I think the one thing too, I've really focused on the last couple of years is really delving into like as many financial history books as I can find on all kinds of different periods of time, all different cycles. And I think that's been a very enjoyable, reading experience the last couple of years, and is really going back into history and trying to connect the dots and look for patterns that I would say are consistent with today. But I think reading is critically important. You have to love reading. Like if you almost have to, if you're not naturally a reader, if you want to be a successful investor, you kind of have to trick yourself into wanting to read. And then at some point, if you're curious for more information, you can sit and read all day, and you like time just passes and you kind of lose track of time. And those are the times I love the most when it comes to reading.
It seems like a general awareness and general knowledge is more important than the fragile spreadsheets based on wrong assumptions that a lot of people like to lean on. It's more important to have maybe a broad knowledge in terms of investing that really separates you from the rest.
Yeah, I think the other thing I would say in addition to that is the one thing and like someone had articulated this to me a couple of years ago. I was listening at a presentation, and the woman said this. She was the manager of the Hawaii pension fund, and she said the most important thing from my path and to get to where I am and to be a successful investor is, she said, it all comes down to pattern recognition. And that was just like, it just hit me so hard, because I was like, that is so right. And it's such a simple way to explain what you're trying to do. And to your point is that you're trying to build a framework and an ability to recognize patterns at a very general level throughout investing, throughout whether it's an individual company, whether it's a cycle, whether it's a period in history, whether it's data points, whether it's narratives or stories. Like there are all patterns that you could build together, and recognition of patterns is like the most important thing, I think, in terms of investing. And then to your point too about spreadsheets and trying to put a DCF together and the very narrow focus of those things. Like, and this goes back to something that Soros had written about in The Alchemy of Finance, and it really also related to me, or hit me hard with. He just said, if you're trying to build a spreadsheet or an argument to buy a stock, the amount of assumptions that you have to put into that spreadsheet are so inherently prone to your own bias, so that as soon as you inject a single bias into an analysis, it's already completely biased. So if you really want to buy a stock, you can build any spreadsheet you want to explain why it's a good stock. And if you don't want to buy a stock, all you have to do is tweak one of the assumptions, and you can say this is not a buy. So, and those are so prone to your own bias. And so it goes back to saying, that is something that you have to, you can look at a model or look at a statement. We very much care about analyzing financial statements, but I would say the one thing that we don't do very much at all is that we almost never try to predict into the future. What we try to do is actually just evaluate business economics, saying, is this a good business? Does this earn a good return on capital? And really trying to understand, the business fundamentals and economics. And I would say you can do that without trying to forecast what the future looks like. And I would say, I definitely spent a lot of time early in my career trying to forecast things for companies. And I realized like halfway in, I'm like, this is actually a complete waste of time, because if I don't understand the economics of the business, it doesn't matter. I can make any spreadsheet look like whatever. And, there's more to it than just building spreadsheets, but it's not something that we completely dismiss, but I would just say there are so many other layers to it that we try to focus on. But it goes back to, you're taught, just build a spreadsheet and give me the price that it's worth, but it's much more complex than that.
Trying to make sure you don't give yourself a false sense of precision.
Exactly. Yeah. That's a great way of saying it.
The purpose of investing, like we said, is to earn a higher rate of return than, say, what the market could give you. But by definition, if you're investing along conventional lines, you're not going to beat the market. So do you find it hard to make unconventional decisions? And how do you make those choices? Is it difficult to kind of go against the grain to try and earn rates of return that are above convention? How do you think of it that way?
Yeah, this goes back to personality traits. There's nothing that makes me more comfortable or feel more natural than going against the grain. And I feel like, I don't know what it is that I'm like that, but I really welcome trying to be different and just not trying to be different for different's sake, but just embracing kind of your own thinking and your own pattern of just making decisions. And I think, when everyone's thinking one thing and everyone is positioned for one thing, most often like something else will happen. And it goes back to like, we try to find investments that we think that people are not really spending a lot of time on. And I think that the way the investment industry consumes information, so much of it is sell-side banks and research sending ideas to buy-side firms. So there's just so much information that goes back and forth. And we try to reject as much of that as possible and to find our own ideas. And at our size and scale, we're able to devote a lot of time to that. We're at bigger firms that need, much bigger teams that are trying to create all these different products. Like, they don't have the time to do that. So we really focus on trying to find things that we think are unique and then being as agnostic to the market as possible. And I would say our best ideas have come from things that most people are not looking at, but you have to be willing to be independent. You have to be willing to be wrong and try to correct your mistakes as fast as possible. But the best way to learn is to make as many mistakes in a small way as possible, but then to be constantly learning from them and receiving feedback back from making your decisions. But if you're not willing to be wrong, then you're not going to find the path to better opportunities. And so that's one thing too I've really embraced. I really don't mind being wrong, and I try to correct my wrong decisions as fast as possible. That's like kind of my caveat. But I would say my best learnings have come from things I missed or mistakes I made. But it goes back to, in investing, when you try not to lose money, you have to survive. You have to make sure that you're protecting people. And so it is a game of survival. So you can think whatever idea you want. You can impose your view on what you think the market should do. But if it doesn't do that, you have to be very quick to saying, I was wrong, here's why, and move on. And that's, I think, a core part of like really good risk management. It's just knowing when you're wrong and changing your mind. And I find it's hard to do, I think, because, people want to be proven right. And I kind of just, a few years ago, after studying some of the best investors, I thought, these guys all recognize when they're wrong fast and move on. And the ability to change your mind fast, I think, is an asset. And you just have to be willing to kind of watch for those kind of mistakes. But being wrong isn't necessarily the worst thing if you can change your mind quickly.
It's easy to be unconventional, but it's hard to be unconventional and right. I think that's the Howard Marks quote.
Yeah. No, he's got a lot of great quotes too.
One way to make a lot of money is to have optionality in life for nonlinear results, maybe in tech or something like that, oil and gas, energy. Have you ever thought about structuring the portfolio to give yourself the nonlinear results? How do you look for those opportunities that really make you 10, 20x returns, or do you chase those opportunities at all?
Yeah, so it's a good question. I think the way I also think about that, and there's one gentleman in particular in the US that kind of has this idea of like exposing yourself to convexity.
Yeah, exactly.
And asymmetry of decisions, like where you want to know what it's essentially what an option payout is. Like you're paying a fixed premium and you have unlimited upside, if something works out for you, and then if not, you know what your fixed loss is essentially. So we think of it. I mean, we don't necessarily think of that in the portfolio from over the short run. So, for example, like there's a number of investments that we own that I would say, over a 10 or 20 year period, have a pretty good likelihood of giving us convex returns. But it's like watching paint dry, where you're not getting that convex returns like very quick. And so I think in that respect, and this is, I would say generally, like one of the most important ingredients to successful investing, but it's one that probably is talked about the least, is time. And so you really need time to do its work, especially when you're trying to compound, and when you're trying to own businesses that are reinvesting in themselves and compounding like that. And so that just takes time. And so we definitely think of that, where you're trying to have, limited downside and unlimited upside. But I would say from our strategy, it really is, we're trying to do that over a long period of time. And if you can do that, you'll have great results and be very, very happy with them. Whereas I think sometimes the convexity gets talked about as like a very short-term thing. And so we're trying to say, we're trying to own things that can be 10, 20 baggers, but it might take 20 years. But if you do the return on them, that's a fantastic rate of return. Whereas I think investing today has become much more short-term focused, and you're trying to get a 10 bagger or a 20 bagger in a year or two, which is just that's not the type of investing that we do. And it goes back to, I think that kind of investing makes it much more prone to somewhere along the way you're going to add zeros to your compounding. And so just trying to remove that, I think, gives you the ability to have like longer term convex returns.
Some businesses seem to have more nonlinear results. Maybe it's a short-term perspective, or you kind of just see the headlines, but have you found certain industries kind of provide that opportunity more, or is it best just to stick with, say, boring businesses like paint? Do you think of it that way? Do you look for opportunities in certain industries?
So I think the one thing that stands out to me is that, like on that, like there's, the focus every day in the paper and investors, it's, what level is the S&P at? What level is the NASDAQ at? What level is the TSX at? The Dow. And so, but if you look at individual companies over long time horizons, there's so much individual wealth being created for companies and shareholders within the market at all times. Like, and it actually, when you think of it in those terms, like the index level will only get you so much, but there's components of the index that are great businesses to own that give you like really good ability to earn long-term rates of return. And I would say the companies are, I wouldn't even say it's a sector thing, but the kind of companies that do that, I find, and this goes back to just once again trying to figure out what works and what's right and what makes money, is companies that have high returns on capital, have low capital intensity, and companies that have good capital allocation. So most often that comes with buying back stock. They can be in a boring business. It's almost better if they're in a boring business and that's profitable, because it's just then it doesn't attract a lot of attention. And like it's amazing to me. There's a couple companies that we own. We only own them for a few years, but like some of the best returning S&P companies that are trading at below market multiple, that have been just amazing, stable businesses that buy back their stock and that have consistent growth, but aren't in a fast-growing industry. Like that is the ideal investment. The one sector I think that stands out to me would be, if you look at the U.S. automotive retailers, like so names like AutoZone or O'Reilly or Automotive, like those companies are 10, 20 baggers over the last like 2 decades, but they trade at a market multiple. It's not a fast-growing industry. It's not exciting. I mean, they're just selling retail products, for automotive parts, but they're so consistent in generating their profits. They're consistent with capital allocation. Management, is very aligned. They own a lot of stock for both companies. And those have been amazing stocks to own, but they're not flashy. They're not exciting. And I would say those are the kind of things that I think I'm most attracted to, because they're also easy to understand. So if I can understand something, it's a fair price, it's earning a good return on capital, I would buy it with both hands all day. And then it goes back to, the other ingredient is time. And then you just let time do its work, and then try, do your best to not sell it. that's also a challenging thing too. Sometimes just to leave it, and that's there's a great Peter Lynch quote saying, selling your winners and buying your losers is like selling your winners is like cutting your flowers, and then buying your losers is like watering the weeds, essentially.
Yep.
And so that's a great quote that I have like pasted on my desk of saying you never want to cut your flowers, and you want to cut your weeds out, and let your high quality companies kind of do their compounding. But there's a couple industries that stand out, but it's generally good return on capital, low capital intensity. That's what drives earnings growth, and over time, earnings growth is what drives the stock.
Depending on your personality, different aspects of investing can be boring or exciting, or different areas of the industry attract different people. How do you structure your day or your investment process so that you don't get bored? Are there certain industries that excite you, or how do you, when you're reading all day, do you read spreadsheets? Do you read annual reports? How do you keep yourself stimulated and excited to go to work? How does that process work for you?
Yeah, that's a good question. So we have core part of my role on the research side is just helping prepare materials for our weekly investment meeting. And so we'll go through a deck of stuff and more so gathering information. And I would say that process of putting work together is, I would say, where I try to be the most creative in my role and in my job. And so, and I, very much treat it like a craft where I'm trying to channel as much creative thinking as I can into that package where we can go through different things and look at things creatively. And I kind of just snowball through a weekly process of trying to, piece things together. And it's not really, I would say my gathering of research and information is not that structured. And I would say it's actually, I try to reject structure, and I try to just funnel stuff into that process. And like sometimes, we'll be a day or two before our investment meeting and I won't really have any much stuff. And then like all of a sudden something came to mind and that triggered something else. And then all of a sudden a bunch of ideas came together to talk about. And then some weeks there's just nothing to talk about. So we kind of will update if there's a company earnings or whatnot. And so the one thing we try to balance our time between doing updates in our meetings about companies that have reported earnings. We then kind of do updates on the companies that we're watching that, are on our list that we haven't quite invested in. And then the other thing I think, we spend a decent amount of time on too is just looking at the economic cycle and sort of going through, macroeconomic data and just trying to, decide what's relevant, what's not. Does that impact any of our thinking? And then we spend some time looking at charts as well. So we do some technical work too. So I think it's kind of a mix of all of those things. And I would say that it's, my colleagues at work are very supportive of me just trying to be creative and like coming up with whatever. And I think we try to keep our meetings like very unstructured so that, and I think that for all of us helps our creativity in formulating ideas and stuff. So that's the one thing, because I think if you spend your day in a very rigid way, I find like that rigidity sort of like restricts your creativity and your creative thinking. And so trying to be not structured or rigid in your daily routine, but then also being creative and productive at the same time, like trying to find that right balance, I think is what I try to do. And so, I'll give you another example is, 3-4 years ago, we would get Globe and Mail, National Post, Wall Street Journal, Financial Times, all to the office every day. And I'd go through all of them in the morning. And I've realized like that wasn't a great use of time because I can consume the news in a much faster way than actually going through the physical paper every day. So like those are things where throughout my career, I've kind of pivoted on how I spend my time day to day. I spend a lot of time looking at spreadsheets, following company reports, listening to companies if they're giving a presentation, those kind of things. And then, there's a day-to-day operations and trading and administration that we all contribute to, being in a smaller firm. But that's kind of going back to it. It's really trying to channel that creativity from an investment perspective.
Some investors would say to invest in what the products in front of you. I think it was Peter Lynch that said, buy the stuff that you use. Some would say invest in what excites you. Some would say go the opposite way and go where nobody else is. How do you think of it in terms of pursuing sectors or industries? Do you go with what you use, or do you go what's not popular right now? How do you think of it that way?
I like that general principle of just like whatever you're investing in, you have to at least understand the business or understand what it is. And so whether it's things that it doesn't have to be things that you know or use, but I would say that generally helps. Like if you have a really good understanding of a product or a business or a store and what the value add is and what your experience is, and you can kind of confirm it by being a regular customer.
Yeah.
I think all of that definitely helps. And if you can understand the business, that's also critically important too. Like for example, it's a couple of weeks ago, but I was in the US for a day, but I made a point of trying to stop in at a few different businesses that we own and just stores that we own in the US and just going in and you stare at the stock all day, you read the reports, you listen to the management, but sometimes you actually have to go into the store and just get the store experience. And that it's always good to do that. I think it's important to kind of know what it's like on the ground with the businesses that you own. And so we definitely try to do that. And I would say if there was anything that we would try to shy away from, it would be the category you said of like things that excite us. And we want to own things that are not that exciting, but that are underappreciated. And usually that comes from something that you either know or you understand, or is a simple kind of thing. And if there's a lot of attention on a sector, that's usually not the best thing. But oftentimes that's not the case, but it's generally something we would shy away from.
Like we said earlier, it's really hard to earn above average rates of return in the market. Not many people do it consistently year in, year out. In your experience, have you seen many people that are able to do that, or is it a rare breed that doesn't exist? Maybe you've been able to do it.
I think the important thing to do to achieve it is you have to be willing to be different. And I think that there's, if you look at all the great investors, this is the other thing I kind of struggle with this a little bit, but I can understand why it's worked for other investors, is that a lot of the best managers or strategies, none of them run diversified portfolios. So like diversification is a thing that is packaged and it has been marketed as your safe thing. It's your safety blanket. Diversification, we're going to own lots of different things. And it's something that we think about, very much so. But all of the best investors don't have diversified portfolios. So, there's the Druckenmiller, keep all your eggs in one basket, but watch your basket very closely.
Yep.
If you look at Berkshire is not diversified. Like they own lots of different things, but the weightings of different things is not diversified at all.
Massive.
And at times they've been super concentrated. And I think that there's an argument for why if your expectation or goal is to have above normal rates of return, you have to be willing to A, be different than what the index is, and B, you have to be willing to be a little bit more concentrated on your rare, really good investments. Because if you just own what everyone else owns, you're gonna get an average rate of return. Which is, for many people, I think this is the other challenge. Most investors actually get a sub-average rate of return because they do things at the wrong time. They sell at the low, or they'll chase in with more money at the high. Like the behavioral side of investing, I think, really hurts people in doing things at the wrong time. But I think if you want to get above normal rates of return, you have to be different, and you have to be willing to be a little bit more concentrated with some of your best ideas. Because this is something that I've struggled with too. Is like, really, when I have a really good idea or something I really believe in, starting my career, I was much more tepid with position sizing, because at first you're just worried about being wrong. You're saying, I want to be able to add value, find an interesting business, but I'm so worried about being wrong. I don't want to size it big, because then if I'm wrong, then at least the loss is going to be small. That's a very, I think, survival mentality attitude that I would say most analysts or younger PMs probably start with that kind of mindset. But over time, realizing when I find a good investment idea, or my colleagues do, like, we want to size it well, like, because there are rare, really good investments or really good businesses out there. So if something is better or higher quality, it should be a higher weight than it otherwise would be. Like, trust in that feeling, and those are little things that would contribute to, I think, better long-term results. You have to be willing to bet your convictions, and then at the same time, if you're wrong, figure it out fast and move on. But you have to be willing to kind of be a little bit more concentrated with your best ideas. And so that's something we try to do. And we do own a number of different stocks, and I would say but there's portfolios I've seen, people own like 50 stocks, 100 stocks, 200 stocks. And, we keep it as tight as possible, close to like 30, 35. And, even to me, that some people would say that's really diversified. Some people are like 20 to 25. But if you own 50 or 100 things, you basically own the market, which is then, why don't you just own the market, essentially?
On the other hand, some investment companies will tell you, they'll admit to you that they are not trying to outperform the market. All they're trying to do is shepherd the capital and not lose money. Does Avenue market itself as a company that outperforms the market, or do you structure it maybe a little bit more on the side of just preserving capital for clients?
Yeah, in our conversations with clients or potential new clients, like we definitely, the way we would articulate it is we're trying to get a reasonable rate of return over long periods of time and to do it very consistently.
Right.
And so over a 1 to 5 year basis, if we're like better than the market or worse than the market, we're actually completely we don't spend any time thinking about that, which is we're lucky because we're not really a firm that's big on marketing or really pushing our message out there. I mean, a lot of our clients have been with us for 10 plus years. I would say most of our new clients come through referrals from existing clients. So we're not really marketing or product focused firm. But from that perspective, I think it's really, you're trying to get a reasonable rate of return over long periods of time. And if you do that, you will have fantastic results, both in most likely, performing better than the market over a long time horizon, but also shepherding the capital. So I would say we kind of think of it in both ways. And the other stat I heard, this is within the last 6 months, but it makes a lot of sense. Like if you look at like long-term top quartile managers, almost none of them are consistently top quartile in any one given year. So a lot of the key to be a top quartile manager over 10 or 20 years is to actually consistently be a second quartile manager in every individual year. Because what it means is that you're avoiding the big drawdowns and you're participating in the up years. But it goes back to, it's actually avoiding the bigger drawdowns that are most important rather than trying to be top quartile every year. If you're top quartile every year, you're probably doing something more aggressive, which then means at some point you're going to be fourth quartile. And so, those two things on their own, I think balance themselves out. And so we try to think about, and I kind of threw some industry jargon with quartiles and stuff into there. Like we think of it trying to be top quartile over a very long period of time, which means we're trying to be second quartile all the time. And that's kind of how we think about it. And I think for us, that means getting a reasonable rate of return, over long periods of time.
You're a partner in the firm, which makes you a business owner and an entrepreneur. The temptation is there to bring on more money and grow the firm as big as possible. Huge amounts of assets under management means big fees for you. Have you had to balance that approach with keeping the firm small, maybe capping your assets under management to make sure you have the maybe less money to generate the higher returns for clients? How do you think of it that way? Is there a tension there?
Yeah, it's a great question. And I think that's one of the key tensions really across the investment industry. I think that a lot of firms are very focused on trying to grow AUM and to gather assets in a way that then maximizes the business value for the owners. And I would say as much as possible, like while still trying to be a successful business, like we really try to reject that as much as possible. And really, even from my perspective, like it's for a selfish reason. It's because I really like doing what I do every day. And if we were a bigger firm and we had an extra 10 or 20 employees and I was having to manage a group of employees and I wasn't actually focused on managing the money or looking at the research side of the business, like I would actually not enjoy my day. And so I think I'm lucky that, all the partners that I work with all have a similar mindset where they still want to, be able to go home and see their family at the end of the day. They were actually, all really enjoy the investing side of the business and they really enjoy the client side of the business. And so if you have thousands of clients, it's very hard to provide a high level of service to all of them. And so we try to really focus on just being at a rational size and doing a good job on the investment side and a good job on the servicing side. And, I joke with my partners that at some point in the next couple of years, I wouldn't mind like just capping it and saying, starting a waiting list. Like from that perspective, I hope that at some point that's what we'll do. And then we'll just focus on doing what we do. We all love doing it, but I don't think any of us really want to be running, a 20, 30, 40 person firm. That's a whole different kind of level of work, skill set. And I think none of us would really enjoy that. So Avenue will never be a firm that does that just because we're trying to grow AUM and run a big firm. We all, if I wasn't doing what I enjoyed every day, I wouldn't enjoy being an Avenue. And so for me, keeping that like it is very important.
I had Guy Spear on the podcast, and he was the guy who had the lunch with Warren Buffett. And I think that was one of the realizations he's had. I think his fund's only $400 million, which is a lot of money. But for him, someone like him, I'm sure could easily get to billions if he wanted to. It seemed like that was the strategy he was taking. So maybe similar to Avenue.
Yeah, well, it also goes back to, the original Berkshire partnerships were very small, and it was like just close relationships that he had.
Yeah,
he kept it that way. And even there's a couple things I read about Benjamin Graham's like original partnerships too. Yep. And they were, once again, it was small. It was like family based. It was friends. It was all referral based. People that passed on, their information. But it was like really not with the goal of trying to grow into a big firm. And I think if you do a good job on the investment side, just the arithmetic of compounding, at 300 or 400 million, in a decade, you're probably going to be considerably larger than that. And then a decade from there, you'll be larger than that just on its own. So we're trying to do it in a reasonable way. But like at the same time, this is actually, it kind of keys into some of your other questions too on the business side. Like it creates its own business complexity if you're trying to focus on growing a huge AUM level, because you're going to need to add a lot more personnel, which takes a lot of work, a lot of time. It makes the overall business more complex from an operating perspective. And if that takes away your attention from managing the money or talking to clients, then that's not great. So it's just we're not at that point where we're willing to do that. I think there's enough alignment with all of us that we just don't put a high priority in trying to be that kind of firm. So, some people will say, well, it would be a good problem to have. At the same time, I think we're all comfortable at our size doing what we're doing, adding new clients as they come to us, but not really aggressively going out there, trying to grow beyond our skis.
Well, I know you don't have all day. I think that's some great info for the listener on Avenue and your investment perspectives and how you approach things and how the business runs. Maybe for the listener, before we wrap up, interest rates are rising. No one's sure really how things are going to go the next year or two. So maybe some dark clouds over the economy. What advice would you give to the average investor out there who on maybe what not to do? How would you leave the listener?
Yeah. So, I would just say that, I think we're entering what I would describe as like a prolonged, challenging investment horizon. And I think that, over the short term, what the market does in the next like 6 to 9 months, I don't have a particularly strong view. My bias is that we probably are going to resolve higher into the beginning of the year and then, wait for the economy or the central bank tightening to kind of, maybe make it a much more challenging environment. But I would say even regardless of that, I just think that the next many, many years is going to be challenging. And I think that investors just have to have a mindset where, any of the money that they're putting into the market does have to be for the long term and to do so in a prudent way where they're not getting too emotional about like the day-to-day, month-to-month moves, because that's, I think, managing your emotions is a very challenging thing. It's one of the most challenging things in investing. And I think for individual investors, you just want to make sure that you're really managing your expectations for what your investment goals are. And if you can have reasonable expectations, it's not hard to surpass those. But if you come at it or approach investing with super high expectations for what you're going to do or what the market owes you in terms of returns, I just think that's the wrong mentality to have. So have reasonable expectations and you'll end up with really good results over whatever time horizon you're using.
Awesome. Well, we can wrapped up the conversation there. I really appreciate your time. Thank you.
My pleasure. It was really nice chatting with you, Trevor, and hopefully chat again soon.
Thanks for listening, everyone. Hopefully you enjoyed the episode. If you like what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee.